Volkswagen, the latest company hit by tariffs. The automaker cuts its full-year forecast, now saying it took a $1.5 billion tariff hit in the first half of the year. Reuters also just reporting EU officials say a deal with the U.S., a trade deal, could happen as soon as this weekend. Joining us now is former Ford CEO and a CNBC contributor, Mark Fields, also a senior advisor at TPG. Mark, 80% of VW's sales in the U.S. come from imported vehicles. So what do you do if you're Volkswagen?
Well, they can do a number of different things. First off, is you just saw from their earnings quarter, it was a kind of a mixed bag. They had to lower their full year guidance, and they faced a number of challenges. But in particular for the U.S., as you mentioned, they're one of the most exposed European global automakers because they import 80% of their vehicles into the U.S. They have a plant in Chattanooga, so they can continue to bring some models over there. They do have not only some excess capacity in the plant, I think they have land where they can expand, but they can only do so much in the near term. So it's going to continue to be an issue for them. And David, the other challenges that they face is besides the tariffs in the U.S., which is a really important growth market for them, they face this really hyper-competitive market in China, which has traditionally been one of their biggest and most profitable markets. They got the European CO2 requirements, which is forcing more sales of EVs, which has lower margins than their internal combustion engines. And I think importantly, and this really wasn't picked up too much in their earnings, but their profits on Audi and Porsche, their luxury brands, literally collapsed in the quarter. And that's been a big moneymaker for them.
Yeah, we should point out they're assuming a tariff rate of 27.5%. It's possible if we do get a deal announcement of some kind, that number could come in lower, as it did for the Japanese at 15%, and their stock prices responding as you might expect. Mark, I am curious, when you look around the world right now, given everything that's going on in your experience, who is best positioned? We had heard from GM and Tesla this week in terms of earnings. I mean, who in your mind is the best positioned or amongst the best positioned automakers?
Well, it's a great question, David. If you think about growth potential going forward, I think the real winners right now, given the tariffs and the whole geopolitical situation, is actually the Chinese domestic brands, because they're keeping their heads down. They're not distracted by tariffs and other things. They have a big export push going on. The quality of their vehicles is pretty best world class right now with the best of the global automakers. So I think they're well positioned. But I think the next best positioned is folks like Toyota. They're steady. They have a very good strategy between EVs and hybrids, which they've traditionally in hybrids been very strong. And they just have a rock solid brand image. And then, as far as the U.S. automakers, both, Ford and GM, they have very big franchises in SUVs and trucks, which drives a lot of profitability. And the weaker ones, obviously, are the Stellantises of the world, the Nissans of the world that are going through some big restructurings right now.
On the Japan trade deal, for U.S. automakers, so there's been some complaints by the industry groups and the unions that it's not fair because now Japan gets a lower rate because most of the parts and the U.S. autos are manufactured in places like Mexico or Canada, and so they actually have to pay higher tariff rates than Japan. Is that a fair assessment? What does that mean for the U.S. automakers?
Yes, Sarah, it's a pretty fair assessment. I mean, I would call this, for Japan, if this trade agreement or at least outline holds, you never know until the ink is dried, it's a win for them, right? They get to avoid harsher tariffs. They don't have any export volume restrictions, which if you recall back in the 80s under the Reagan administration, they put those restrictions in, which then forced the Japanese to build more production here in the U.S. And it stabilizes the trade outlook for them. From the U.S., if you're a U.S. automaker standpoint, it's kind of like just empty calories, because at the end of the day, we get more access to the Japanese market, but our products are not particularly preferred by the Japanese. And you got this really oddball situation where, as you said, U.S. automakers, they're at a disadvantage because many of their North American built vehicles, which do have a lot of U.S. content, face a 25% import tariff coming from either Mexico or Canada, while Japan has a lower tariff at 15%. So you got this situation that, North American vehicles with a lot of U.S. content face a higher import tax than Japanese with very little U.S. content.
Yeah, it kind of gets to that, this sort of weird unknown, Mark, where's the line between truly unfair, non-tariff barriers, right, where markets are closed to our goods, and simply a bad fit between what we make and what they want, right? You see it in cars in Japan, you see it with beef in Europe, and so maybe not Australia now, but
they're going to buy our
right?
beef.
Yeah, I mean, you're exactly right, Carl, and that's why it's really important in this case for the automakers to be really clear to, the Commerce Secretary and the other members of the Trump administration on what is really going to be a win for the U.S. automakers. Because you're right. I mean, listen, there's not a Japanese, hankering for a big F-150 pickup truck or a big suburban, SUV. You can't even fit them in the streets. Nevertheless, they're driveways. And so, it's a little bit of, you get these kind of hollow wins with greater market access for a market that really doesn't fit for U.S. products. So they have to be very clear on what they really want to make the trade practices fair, for at least for the automakers.
Mark, always interesting, always appreciated. Thank you.
Thanks, guys.